Hi. If you are an individual investor, if you're somebody who manages your own portfolio, or potentially you want to see whether or not it's possible to outperform either the returns that your mutual fund or financial advisor is or has provided you over whatever period of investing you've been involved with, I may have some insight into how you might be able to protect your portfolio while also taking advantage of upside potential in terms of the markets. My name is Jared Ayers. I am a CFA charter holder. I've been investing my own money for just about 20 years now. I've been able to see substantial returns myself over and above what the market has been able to produce. My approach to risk, how I measure it, how I manage it, is what I find is the biggest differentiator between how I invest and how others invest. I find myself being asked all the time by people within the investment industry and outside, people that just have an interest in investing for themselves, how I invest. And I want to create a number of videos to share with people how I approach investing, my thoughts on risk, how to measure it, and how you can look at indicators that are telling you what the economy is doing, what it's not doing, and how you can structure your portfolio to indeed protect yourself from catastrophic losses while maintaining upside potential in your total portfolio. I do want to make a point. I am a human being. I am not a robot. I do my own research myself. I have a full-time family, a full-time job, and I don't have a ton of time myself for investing or investment research. I need to pick my places very carefully, but my background and my skills have allowed me to understand exactly where are the best places to find the key information that I need to make sound, confident decisions in terms of my investments so that I can sleep well at night. And I want to share that with basically anybody who wants to know a similar set of information for their own purposes. In terms of myself, I am not a market timer. I don't forecast. I use data, like I said, to decide what's actually going on. I take that data, I look at it, and I decide effectively how I want to structure my portfolio based again on how I look at risk, how I measure it. And quite frankly, I don't trust anybody else because I don't think anybody is as good as me to manage my money. One of the things I guess that's common in terms of advice or in the media around risk is the thought of volatility and diversification. Volatility being a measure of risk and diversification being a way to manage risk. Well, I don't necessarily agree with those ideas, and I want to share sort of how I look at risk, how I measure it. I do use economic indicators, not a ton of them, which may surprise some people, but enough of them that keeping track of them on a fairly regular basis, but really very minimal time involved, I get to see exactly what's going on in the economy ahead of how the market will actually react. Remember that obviously the markets lead the economy in terms of what's going to happen next. So obviously if you have investments in the markets, then you want to be thinking about how to structure your portfolio before we enter into a financial crisis, a recession, or any kind of event or economic occurrence that might set people back significantly in terms of their total returns of their total portfolio. I don't necessarily believe or agree with the common thought process out there around asset classes themselves. I have my own definition. I think of them differently than I think many people do, and I obviously consider the assets that I do allocate my portfolio to based on the economic indicators that I follow. So that's also, I think, a unique way of how I think about investing, and I think it's something that isn't that common across those that do invest either for a living or privately with their own money. The other area obviously that I want to share is how I select specific investments within each asset class. Every single asset class has its own risk characteristics and performance characteristics, and it's obviously very essential to understand how each asset class behaves, not only relative to each other, but within different economic situations, in absolute terms within the class itself. So I, for instance, have a very specific set of criteria that I use for selecting stocks. It's my own preference. I'm not a trader. I'm not, let's say, a growth investor. I'm not a value investor per se, but there are elements of both of those that I look to, as well as special situations. Leverage is another area of investing that is somewhat scary for people. Leverage usually comes with the term risk attached to it, but I do use leverage to manage the risk in my portfolio, sometimes basically nullifying or locking in the downside, so I know exactly what or how much I am actually at risk, so that I can then basically take advantage of upside across the rest of my portfolio. So I want to share how I use leverage, what kind of leverage I use, and how that can really impact the overall return of the portfolio, or even within the asset classes specifically. As you can tell from my comments, I am extremely risk adverse, but looking at the portfolio that I have, it may appear that I'm actually have a very high risk tolerance. So again, it's that sort of perception versus understanding exactly how I do structure my investments, how I structure my portfolio, how I use asset classes to and certain investments within those asset classes to nullify risk, while taking advantage of what the economic indicators are showing me is likely about to happen. I've never been a fantastic forecaster at anything. I find I don't really know anybody who is. I find people are either right about when something will happen, or they'll be right about what will happen. But they are very, very rarely right about both what will happen and when it will happen. You'll hear it all the time. There's a market correction. People will be, oh my God, the sky is falling. The stock market, is going to crash. We're going to head into a recession. But you hear that over and over and over, and all the time it's the same people calling it. But it may or may not happen. Oftentimes it doesn't. Oftentimes it's just a correction. But I want to share also what I think about in terms of market crashes, corrections, market timing. Basically, I believe you should be picking your places in those areas that you can easily understand, and leave the areas that you cannot understand to people that really are just seeking some media attention. So that's basically what I wanted to share today. I would love to hear from people about what you may want to see from me. I would love to hear from you about what you think of in terms of risk, how you manage risk in your portfolio. Any questions you have around that, fantastic, drop me a line. And I look forward to this being the first of many videos where I get to share basically a passion I have and a hobby that I love. At the same time, I get to make money while I do it. So happy investing, and I will hopefully see you another time.